Great question. This is different Jack. This is Jack B. Jack F's been the one who asked initially about that. Jack B is asking this question. By selling a closer month at the money call, aren't you risking an early exit on a stock that's going on nicely? Absolutely. So the at the money bell curve is showing us where I want to be selling close to, Jack. Income method number one is just selling a call against the married put position. But I want to do it at the right time. Okay, I don't want to sell a call right away. Why don't I want to sell a call right away? Remember what I said with this married put. If I open this married put, it's because I have the expectation the stock's going to move up 3 to 5, maybe 6% in the first 15 to 30 days or so. Why do I want to sell a call now if my expectation is the stock's going to be closer to 21? I want to wait till that point. And when it gets to that point, you're absolutely right. Shorter term, 14 days out, I may look to sell the 22 call, the 21.50. But talking about those stock charts again, Jack, and the blueprint doesn't go in depth into that as it might seem I'm saying, but usually when I use that income method number one, it's been after a strong rise of the stock and now it looks like it's hesitating. Of course, I would never do this, but if I did something right off the bat, income method number 6 in the blueprint is a way to still generate some income on the position while leaving the upside completely open. Essentially, I could still sell that at the money 21 strike call. I'd wait for it to move up a little bit more. But if I take some of that premium and buy a higher strike call, if the stock keeps exceeding my expectations, I've left the upside open because the benefit of the long call. That's income method number 6. Of course, the only way to get the full details on all of the income methods there is to take a look at the blueprint, which goes through the entire setup, structure, put selection, stock selection, and the ins and outs of the entire 12, actually now 13. There's a 12B as well. I'm sorry, income method number 1B is income method number 1. So there's really about 13 different income methods to start lowering that initial at risk, when to use them, when not to use them, and helping you get your position more bulletproof strategy. And Jack, don't get me wrong. I am not saying that I'm selling the at the money call. Okay, I'm saying that that's where the premium is, where you want to be selling. I never sell an at the money bull put. And if I'm doing just a covered call or a naked put, a cash secured naked put, I'm looking for a 75 to 80% probability. So Jack's question is, sorry to belabor the issue, but selling a 30 to 35 delta, which would be a 70 to 65% probability, expiring worthless. But he says, sorry to belabor the issue, but selling a 30-35 delta, the put expiration gives much more credit at the time of entry, reduces the risk even more. Okay, and it relieves the trader from being right about price downturns. What's wrong with your opinion? I know if you get the downturns right, you may collect profit. Okay, back to married put search. We're at Barrick Gold. Now, Jack's saying that I showed, hey, well, I could sell this call and do this. I did that as an example. That's never what I would do in this married put. Go back, and if you remember Jack B, going back to the discussion, I said that I'm opening a married put because I have the expectation, beyond what's shown in the search, based on my chart reading, what I like to look for, I have the expectation that this stock is likely going to move up 3 to 6%, let's call it 5%, in the next 20 days or so. And at the same time, I have a sentiment based on market conditions and other aspects that I think the stock can continue to move up another 8 to 10% in the 60 to 90 days following that. Okay, so yeah, I know we're looking at a small price stock here, but in a little bit from now, I expect the stock to move up $1, right? 5% of 2011. So I'm expecting it to move up $1.05 or something like that, where it's going to be at 21.05. So Jack B's comment is saying that, look, you showed a quick example where you sold an October 18th call and then you only got 20 cents for it, but then you bought a higher strike call, so you took 10 cents away, so you only got 16 cents. Well, that was just a graphical example. That's not something I would do when I first open a married put, because my expectations are that this stock could be up in the next 90 days through different patterns and different market conditions going through the election. Could be up, as I mentioned, up to about $23, $24 per share. So he says, oh, well, just, go further out in time, go to your April expiration. Let me go to the option chain here real quick and just sell your 0.3 delta all the way out to April. Okay. Now he's not wrong. Well, I mean, you're not wrong in that assessment, Jack B. I understand what you're saying. Where's my delta there? So let's go to medium chain. The 0.3 delta. So I get the 23 strike. Now I'd be at 24 or 23, 105. Let's go to the 23 at 105. Sorry. So I want the April 23 strike. And we're going to get 105 for it. And remember, my risk was only 137. Okay. So I'm here at this position, and I've still got a 1.5% risk. Yeah, I reduce it. I can make a max return of 8% in 190 days. Not terrible at all. It's kind of within the wheelhouse of what I'd look for. About 1.5% to 2% per month is the goal with the married put approach there, Jack. But if I'm doing a structure like this, I'm opening a standard long collar. The return went down to 1.5%. That's great. The return went up to a max of 7.9%. And that's within the wheelhouse of what I'm looking for. But again, if I just keep selling the shorter term 0.3 delta time and time again, I'm going to collect more than 105 at that time. Now, I know the 0.3 delta for the shorter term might only be the 22 strike, which maybe might put me at a loss. What I'm saying here, Jack, is that you're not wrong in your comment at all. I understand what you're saying. And that's something I would look for if I was doing a long collar position, where I'm looking to have protection similar to a married put, but I'm in a shorter term trade that I don't have a more bullish outlook on. I'm using the married put because I have a much more bullish outlook and upside outlook to it. I'm okay controlling my risk. I'm sorry, in the initial married put position. Oh, shoot, I kept moving off it. There we go. Okay. I'm okay keeping this risk on my married put position to 6.1% and doing the adjustment shorter term and knocking it down, but following the market movements. Because why? It's not just about selling the call. Remember what I said, this doesn't go to zero. 4 of the 13 different income methods in the blueprint are ways to manipulate this put option to reduce your risk, reduce your percentage at risk, average your cost basis down, or profit even if the stock moves in a downward direction. There are 4 income methods. This is not just insurance. This is a second working asset. That being said, if that position you just looked at, whether or not you wanted to use Barrett Gold because you use different search criteria than what we show in the married put for these positions, this to me is a different structure. I use this shorter term, occasionally 1 month out in time, for a position to get a good premium, maybe 2.5% if I'm assigned in 14 to 20 days, and keep the risk control to only 4%. The married put approach I'm using because I have more of a bullish expectation longer term on the trade. I typically would never have a collar. Standard collar position, same expiration, 0.3, 0.4 delta on the call. And yeah, if I did a collar right now for October for Barrett Gold, I'm buying the stock at 2011. I'm probably selling the 21 strike October 14 day out call and buying a 19 or 18 put. And that's probably going to give me a structure with maybe a 1.5%, 2% return. Okay, 1 to 1.5% return for 14 days with a risk of probably 2.5 to 3%. And I'd be willing to take that on that shorter term trade because I'm not looking to hold the stock long term for a longer bullish run. That's what I'm looking for with the married put approach. I'm looking for stocks that I know, even I bought the put 195 days out, but I'm not expecting to be in this trade necessarily for 195 days. Okay? If I reach within 130 days from now, 120 days from now, I reach within 70 to 60 days of that put expiration. If I've met my goals, I'm probably just liquidating before what? Before that last quick turn of the time value and extrinsic value decay goes into my put option. Or I'm going to roll the put further out in time to continue the trade if I've got a bulletproof position and I can keep it in near bulletproof status and add an extra 6, 7, 8 months to it if I'm still that bullish on the position going forward. But usually at that time, what I find, Jeff B, is that another stock comes up in the search results that better matches my expectations. This is a common trade. And what I mean by a common trade is that when I first started with power options, we had customers who were Ameriprise financial advisors, worked with American Express, and we also had another group from different financial advisors, several of them across the country, that were allowed to trade options. They would use our site. A lot of them that I talked to for their customers would do positions like this, not with the April 21 put, by the way. If you did a long collar like this, usually you don't buy an in-the-money put. If you're going forward in time, like I said, your structure would probably be selling the 22 or 23 strike call for April, and you'd be buying an 18 or 19 strike put. Let me just change that up to the 18 or 19 strike put here for April. Actually, let's go all the way out to 2000. Let's go a year out. We go a year out. Yeah, September. Let's go to September, 350 days out. We're going to sell the 22 strike call. I know it's really close. Now let's go to the 25 strike call, and we're going to buy that 18 strike put. It's going to be a little bit different. So what do I need to clear out? This one. So we're selling the 25 call, Jack B. We're buying the lower strike put in this case. Okay. This is beyond what they would show. So they'd probably use different strikes. But what they would typically show their customers, they say, hey, here's what we're going to do with your position. We're going to buy Barrick Gold or some other stock, IBM, and we're going to sell a call that's 10% out of the money, and we're going to buy a put that's 10% out of the money. And in 350 days, you could see a potential 23% profit on your position, but you could never lose more than 11%. Usually it was much closer ranges, as you can imagine, because the customer might not want to see this. So they would say, hey, the worst you could do is an 8% loss, and in 12 months, you could have an 11% gain. And they don't have to do anything. Who else doesn't have to do anything? The broker doesn't have to do anything. They've set in a long collar position, 25 clients, 20 positions in each one, 410 trades, all with this same structure. All they have to do is check in every 3 to 6 months and say, where is it? Oh, it's in the middle. It's still good. Where is it? It's near the put. Okay, it's still good. Where is it? Oh, it's up near the call. Still good. Okay, 12 months from now, 15 of your positions in a good month got assigned. The other 5 took a loss of only 2 or 4 or 6%, and they had to do nothing. You want a relatively close to no action trade long term, where you know you can't lose more than 8% and you could potentially make 11% in 6 months. That's the standard collar structure. Almost, not really, but almost fire and forget, because you still could lose this value. You could also still make this value, and you don't have to do much management, movement, or things like that. The married put approach, as I mentioned at the beginning of the presentation, the first part of discussion, is a bullish trade. I'm looking for stocks that move up, and I want to have a bullish expectation for an extended period. How do I look for that? How do I know that? Well, that's sort of all discussed in the different chapters in the blueprint. As we go through the table of the contents, introduction, options basics, yeah, you guys can skip over that. The married put setup, a review of the trade simulator tool. But length of time for the play, why it works over the long haul, the SIGA model. That's the model that we use for decision-making processes, for not only getting into the stocks or doing the position as well, okay? Which price to sell, which month to sell, premium to expect, other guidelines, mistakes, income method number 1 approach, and evaluating cash flow. Then we go into the individual income methods, 3 and 4, adjustments on the put, adjustments on the call, ratio spreads, call spreads, income method 7 and 8, another put adjustment here, income method number 9, what to look for with dividends. There is such a thing as trading the married put with too high of a dividend. Bulletproofing, different ways to bulletproof, combining income methods, which, as you can imagine, Jack B, he said, Jack B comments, adjustments are the key to profitability. I would continue rolling the puts. Exactly. And you could do that too, Jack. But the married put structure that we showed first, and using the shorter term calls, you're still giving yourself more of a bullish skew. Remember the radioactive decay line I talked about? I sell that call 195 days out. I'm not going to start seeing the time decay I want on that, especially if the stock is moving up, because it's getting closer to that at the money bell curve now. I'm going to see an increase in extrinsic value. And it's going to be harder to roll that call at that 23 strike we showed at Barrick Gold. Yeah, you can still adjust the put, absolutely. But I'm doing the same put adjustments with my April put that you have, and I'm just doing shorter term trades occasionally here and there when I see the right stock patterns I want. Different ways to trade it, absolutely. If you're comfortable with the long collar, Jack, no problem. That's also a popular thing. That being said, Jack B does say, having said that, the blueprint is the best approach I have seen in 30 years. Keep on doing the wonderful work of training traders. Thank you, Jack. I appreciate it.